All right, let's dive in. Today, we are pulling back the curtain on the world of commercial real estate. We're going to break down how those massive office towers, shopping centers, and apartment complexes actually go from just an idea on paper to a real, tangible, income-producing investment. So let's start by framing just how different this whole world is.
Now, really think about this for a second. That app, it might have totally explosive growth, right? But the building, it is playing a completely different game. One is built on lines of code. The other is literally built on concrete. And that question, it gets right to the heart of what makes commercial real estate such a unique and honestly powerful type of asset.
And that's because it's what we call a real investment. Here's a way to think about it. Buying a stock is kind of like buying a piece of the recipe for a company's success. But investing in commercial real estate, that's like buying the kitchen itself, the tangible, physical place where all the work actually gets done.
So yeah, you're right. It might not have that flashy, headline-grabbing growth of some tech startup, but its real strength lies in something way more fundamental: stability. I mean, at the end of the day, people always need a place to live, and businesses need a space to operate. And those long-term leases create a dependable stream of cash that gives investors low volatility and really stable value.
Okay, so before we can even think about building something, we have to understand the unique physics of the real estate world. Trust me, it does not operate like other markets, and there are some fundamental rules we just have to get down first.
You see, it's this whole web of factors that really defines the game. It all starts with the basic fact that you can't make more land, and every single property is unique. Because they're all different, transactions are naturally slow and super expensive. Then you add in the fact that these buildings cost a fortune and are built to last for decades. Well, of course you're going to get heavy regulation and the need for intense management. You see how they all just feed into each other?
And what does all this add up to? Well, it creates a crucial economic concept: inelastic supply. Think of it like tickets for a sold-out concert. Once they're gone, they're gone. You can't just magically add more seats to the arena. It's the exact same thing with real estate. If demand for office space in a city suddenly spikes, you can't just build a new skyscraper overnight. That supply is fixed, at least in the short term, which has huge effects on pricing.
And just to give you a sense of how costly this is, look at this number. We're talking 3 to 5% of a multi-million-dollar property's value just vanishing into the costs of buying or selling it. This is not like trading stocks with a few clicks on your phone. It is a major, expensive undertaking. And this is exactly why supply is so slow to respond. The journey from a vacant lot to a finished building, it's a marathon, not a sprint. It's dictated by this maze of zoning laws, building permits, and city plans. That long production cycle is a fundamental rule of this game.
So, now that we've got the rules down, let's actually follow the journey. We're going to walk through the entire life cycle of a commercial building, from just a simple idea all the way to a fully operational asset.
You can really think about this journey in 3 distinct phases. Each one has its own goals, its own unique risks, and a lot of the time, its own special set of investors who really know that particular stage. So let's start right at the beginning.
Phase 1 is all about potential. Now, this is by far the highest risk period. A developer is spending serious money on analysis, design, and approvals before a single shovel ever hits the ground. And that's the key. If they can't get that all-important municipal approval, all that initial investment could be completely lost.
Okay, so you get the green light. Now we enter phase 2, construction. With all the approvals and financing in place, that initial risk definitely drops, but it doesn't disappear. This is where the blueprint starts becoming reality. But, things can still go wrong. Cost overruns, design errors, or even a sudden shift in the economy can totally threaten the project's bottom line.
And finally, we hit phase 3, operations. The building is done, it gets a certificate of occupancy, and tenants start moving in. Now the asset is finally generating income, the risk just plummets, and the building becomes attractive to a totally different kind of investor, someone who's looking for stable long-term cash flow, not all that development risk.
So we've built our building. Awesome. But what kind of building is it? Well, in the commercial real estate world, investors tend to focus on 4 main product types, and they often call them the 4 food groups.
And here they are, the big 4. Office, where companies do their work; retail, where we all go to shop; industrial, which is the backbone of logistics and all our data; and of course, multifamily, where people live. Each one of these behaves differently to economic trends and has its own unique set of tenants and risks.
But it gets even more specific than that. As you can see here, an office building isn't just an office building, right? It could be a Class A trophy tower right in the middle of a downtown, or maybe a Class C building out in the suburbs.
These subcategories are absolutely crucial for how investors analyze risk and potential returns.
All right, our building is built, it's classified, it's full of tenants, but who is actually running the show? A building doesn't manage itself, so let's look at the final piece of the puzzle, the people who are responsible for making it a success.
And understanding this comparison is absolutely key. The property manager is on the ground, dealing with what they call the 3 T's. That's tenants, toilets, and trash. Their goal is to sustain the building's value day to day. The asset manager, on the other hand, is focused on the big picture investment strategy. They're the ones asking, how can we create more value? Should we do major renovations, sign a huge new lease, or is now the right time to sell?
And here's how it all fits together. The owner sets the goal. The asset manager creates the strategic playbook to hit that goal, and then the property manager executes that playbook on the ground every single day. It's a really clear chain of command where strategy flows down and information flows up, all designed to protect and grow that owner's investment.
So we've taken this journey from a simple plot of land all the way to a fully managed asset. But the journey, it never really ends. The world is changing faster than ever. The rise of remote work is challenging the whole idea of the office, and e-commerce is doing the same thing to retail. The crucial question now is, how will the owners and managers we just talked about have to adapt these massive concrete structures to make sure they can not only survive, but actually thrive in the cities of tomorrow?